Hello, DIY investor. Market downturns can be an emotional roller coaster for even the most experienced of investors. And if you're investing with margin, market volatility can have an even greater impact, potentially triggering what's known as a margin call. But what exactly is a margin call and why does it matter? Let's break it down. When you use margin, you're essentially borrowing funds from TD Direct Investing against the value of eligible assets you hold in your margin account. If you're holding long stock positions in your margin account and you see a negative cash balance, that means you're currently borrowing on margin. So imagine you have $6,000 in cash in your margin account and you want to buy shares of stock ABC1. If ABC1 stock has a margin requirement of 30%, you'll only need to put down 30% of the total value yourself. With your $6,000, you could potentially buy $20,000 worth of ABC1 stock. TD Direct Investing would then lend you the remaining amount. This loan will appear in your account as a negative cash balance. Remember, the maximum amount TD Direct Investing can lend you depends on the current market value and the margin eligibility of the holdings in your account. This is also referred to as your buying power. After buying a security, you can see the loan value you're receiving on the holdings page underneath the current market value. If the price of ABC1 stock or any other marginable stocks in your account drops, the loan value TD Direct Investing assigned to those shares will also decrease. And if the total loan value of all of your holdings becomes insufficient to cover your negative cash balance or the amount you're borrowing, your account will then go into a margin call. This is a notification for you to resolve the shortfall, usually by depositing more funds or selling securities to bring your account back into good standing. So, how can you avoid getting into this situation? Here are some tips to help you identify and deal with potential risks as a margin user. First, maybe the most important tip, prepare for market volatility by creating a buffer of margin. Markets are cyclical, where a 10% drop is considered a typical market pullback and a drop of 20% or more is considered to be a bear market. So you might want to consider aiming for a buffer of at least 10 to 20% of your maximum available margin at all times. Think of this as the difference between your total available loan value and the amount you've actually borrowed. For example, if your holdings at the start of the day give you a total loan value of $50,000, a 20% buffer means you would aim for a buffer of at least $10,000 in margin, meaning you would try not to borrow more than $40,000. However, the size of the buffer should be determined by your risk tolerance and what you're invested in. If your portfolio is concentrated in one sector or stock, or it holds volatile stocks, you could consider a larger buffer of maybe 30%, 40%, or even more. It is up to you. Tip number 2, review your account for risks. Markets tend to move quickly during downturns, so you should review your account to check for risks, especially if you have relatively higher risk portfolio or one that is close to being in a margin call. It might even make sense to check your account daily during extremely volatile times. What risks are you looking for? To start with, stocks that can become non-marginable or have their loan values reduced by TD Direct Investing, sometimes with little notice. This is especially true for those highly volatile stocks or those falling below certain price points like $5 and $3. For example, a stock trading at $50 per share might typically require 30% margin. But if that stock is highly volatile, has relatively low volume, and has other elevated risk factors, then the margin requirement could bump up to 50%, 75%, or even 100%. It's important to note that this can significantly reduce your overall loan value without a significant change in market value. For more info, check out the help section in WebBroker on margin requirement guidelines at TD Direct Investing. Also, if some of your holdings fall into this category, you might want to consider a larger buffer of available margin. On to tip number 3. Think about canceling your open buy orders. Open buy orders to buy more securities will tie up margin and reduce your available buying power or margin excess. If you're running close to your buffer, you might need to modify or cancel them to stay within your limit. Lastly, tip number 4. Consider selling your money market funds. Your money market mutual funds are not quite the same as cash, as they only provide a loan value of 95%. This means that you could gain an extra 5% in available margin by selling them. Now, of course, even with the best planning, market volatility can sometimes lead to a margin call. If you do find yourself in one, it's crucial to take action promptly. You'll typically need to deposit funds or sell securities to bring your account back into positive margin territory, which we cover in detail in another video. I hope this helps you navigate margin trading with confidence. Thanks for watching.
Have more questions? Check out the links to the right and in the description below.